Net income is a major part of how investors and creditors evaluate a company's financial health. So we need a set of rules for how to record the two components of net income, revenue and expenses. Whether you're following GAAP, IFRS, or ASP accounting rules, we use a system called accrual-based accounting to recognize our revenues and expenses. Let's unpack that system today. Sometimes recognizing revenue is easy. If someone comes into my pet store, hands me a $20 bill, and walks out with a goldfish, most people would agree that my store earned revenue of $20, and that I totally ripped that guy off. But sometimes the transfer of cash doesn't occur at the same time that a company performs its end of the bargain. Perhaps a customer special orders a piranha and pays for it a week before he comes to pick it up. Or I give a customer a blowfish and she agrees to pay me next month. If the payment and the pickup occur on different days, on which date should I record revenue? In short, in accrual accounting, we recognize revenues when they are earned. That is, when your business actually performs its end of the bargain, not when cash is paid or a contract is made. We can think of three different scenarios. We could receive cash and earn revenue at the same time. We could receive our cash before we earn revenue, or we could receive cash after we've earned our revenues. In our goldfish digger example, someone came into my pet store and purchased a goldfish for $20. Here, the pet store provided the goldfish at the same time that cash was paid. This is pretty common for small everyday purchases like groceries and clothes. To record this journal entry, I would simply debit cash for $20 because cash increased, and credit sales revenue, increasing shareholders' equity because I earned this revenue. But what if we receive cash from customers before we perform our obligation? This is common for concert tickets or insurance policies where customers pay in advance. In these cases, I must debit my cash when I receive the payment, but I can't yet credit my revenues because I haven't actually performed my obligation. The accounting equation must always stay balanced, so this will produce two separate journal entries, one on the date that cash is received, and another on the date that revenue is recognized. Recall that journal entries must always involve at least two accounts and must have an equal number of debits and credits. To determine which accounts are involved in these entries, let's consider the customer who special ordered a piranha. Suppose she pays me $50 on the first of the month when she places the order, and we agree that she'll pick it up on the 15th. I would record this increase in cash by debiting cash for $50. What should I credit so that this entry will balance? By taking the money, I now have an obligation to provide this customer with a piranha, so I will record a credit to my liabilities. We call this liability an unearned revenue. Ironically, unearned revenues are not actually revenues. They represent an obligation the company has to the customer, not to pay cash like most of our liabilities, but to deliver a good or service. You can think of unearned revenue as a waiting area where revenues hang out until they're earned, kind of like purgatory. Then on the 15th, when I give my customer her piranha, I can finally record my revenue of $50. I'll credit revenue for $50 and debit unearned revenue for $50. This wipes out the unearned revenue and moves it to my revenues, because by performing our end of the sale, we have now earned this $50. Notice how our accounting equation is still in balance. When revenues are recognized after we receive cash, we call this deferred revenue, because we're deferring or putting off recognizing revenue until later. But what would happen if this situation was reversed? Suppose we receive cash from the customer after we earn revenues. Let's say we give the customer her blowfish on the first of the month, and she promises to pay us $100 on the 30th. On the first, we would credit our revenues for $100. What would we debit? We can't debit cash since we haven't received cash yet. Instead, we have received another kind of asset, a promise to receive cash in the future. We call this an accounts receivable. Accounts receivables arise when goods or services have been delivered to customers, but the customer has not yet paid, like an IOU from the customer. A receivable is a current asset because it has future value to the company and will be converted into cash in the near future once the customer pays us back. Any day now.
One eternity later.
When we're paid on the 30th, we'll debit our cash for $100 and credit our accounts receivable for $100. We're essentially swapping one asset, a promise of future cash, for another asset, cash. When revenues are recognized before we receive cash, as in the blowfish example, we call this an accrued revenue. And when revenues are recognized after we receive cash, as in our piranha example, we call this a deferred revenue. Don't stress about memorizing the terms accrued revenue or deferred revenue. It's far more important to understand how you should journalize these two situations under accrual-based accounting. Now, I know what you might be thinking. Wouldn't it have been way easier to record revenue on the day that I received my cash? That way I could combine all of this into one entry and get rid of all those pesky extra accounts like unearned revenue and accounts receivable. Recording revenues when cash is paid is known as cash-based accounting. But no, you can't get off that easy, you sneaky little sneak. The reason we follow accrual-based accounting instead of cash-based accounting is that cash is much easier to manipulate. Suppose a CEO is $10,000 in sales away from getting his Christmas bonus, so he asks a few customers to pay for next year's orders early in exchange for a discount. Or he borrows money from a supplier and records this inflow of cash as a revenue instead of a liability. Both of these actions technically generate cash, but calling them revenues doesn't match the economic reality of these transactions. Accrual-based accounting is important because in the real world, we don't always receive cash and earn revenue at the same time. This chart summarizes the format we used for journal entries in each of the three scenarios. When revenue is earned before cash is paid, we debit accounts receivable and credit revenue. When cash is paid before revenue is earned, we debit cash and credit an unearned revenue liability. And when both occur on the same date, we simply debit cash and credit our revenues in a single entry. Now let's move from talking about revenue recognition to expense recognition. Just like with revenues, expenses are recorded on an accrual basis instead of a cash basis. So join us to watch part 2 of this video, linked in the description. And if you want to see more examples of recording revenues, make sure to watch our example video linked below. And if you want to see us continue to make videos, please give this video a like, leave a comment, and hit that subscribe button. We'll see you on the next one. Kylie Jenner. Okay, let's do this.